Thank you for joining us. I'd like to call the Virtual Finance and Administration Committee meeting of January 21st to order. It looks like the three members of the committee are present, being myself, Mr. Sweeney, and Ms. Fay. So with that said, we'll come to order. I'm going to deviate a little from the agenda, move things around. We do have bond counsel present, and I think it would be best to and others who have joined us, professionals here on the POB agenda item. So I think it would be appropriate at this time to move to that. So I'd like to first take up item 3B, the discussion of pension obligation bonds and pension bond reserve fund, and I'll turn it over to Mr. Hart.
Thank you, Deputy Mayor. Good evening, everyone. Matt Hart, Town Manager. Good to see you all online tonight. Thank you for joining tonight's meeting. So for our purposes of tonight's discussion, you've been reviewing the proposal to issue pension obligation bonds for some time now. As you know, you're going to be holding a public hearing on the matter in advance of next week's regular meeting on Tuesday night, and then you'll be taking up the item for consideration as part of the regular meeting that evening. Tonight, we really wanted to focus on three things. We wanted to talk about the cost savings associated with this plan, more formally referred to as the deterministic projections. We want to talk about that because they are significant. They are significant. Almost $141 million net present value over the issuance of the bond period. Secondly, we want to walk you through the proposed ordinance to establish the pension bond reserve fund, just so you know how it works. And then last but certainly not least, we want to take any outstanding questions you might have, your comments, your points. I do want to provide a brief overview, but again, just so everybody knows who's joined us tonight, we have the team who's been working very hard on this proposal for many, many months now. Peter Privatera, our Director of Finance. I see Matt Ritter, our bond counsel, has joined us. Bill Lindsay, our financial advisor. Becky Seelman, our actuary. And Chris Kashmar, our investment advisor. So they're all here to assist with your questions. So as a quick overview, again, you're considering on Tuesday night, you're going to be considering the issuance of $365 million in pension obligation bonds for a 25-year term. 25-year term. As we know, the bond repayment schedule, it's going to be level payment. Level payment. What does that mean? That means that the town is going to make the same payment each and every year over the 25-year repayment schedule. And at the end of 25 years, the bonds will be fully paid. The bond issuance will bring the town's, our pension plan, to approximately 100% funded, a little bit less, as of July 1st of this year. And we'll talk a little bit more about that later on in tonight's discussion. If you approve the issuance, our pension board will deposit the proceeds into the pension trust. They will gradually invest the funds in higher yielding asset classes. As you know, we're assuming a very conservative discount rate or earnings rate of a 6.25% over the entire life of the bond repayment schedule. That will change, from year to year, but that is our estimate over the life of the schedule. And the 6.25 compares quite favorably to our anticipated interest rate on the bonds, which we are projecting at 3% or less. So why again is the team recommending this? And why again is it before you today and next week? First of all, the unfunded liability in our pension plan, we all know that it's significant. It currently totals $315 million, and our funded ratio is a little under 41%, 40.6 to be exact. Now, the town and you, the council, have been very, very diligent over the last many years in trying to address the pension fund and to increase that funding ratio. We've done all sorts of things. We've adjusted the discount rate so that it better reflects market conditions. We've introduced updated mortality tables that are consistent with today's longer lifespans for plan participants. We've made various adjustments to the pension benefit levels to lower the cost of future payments. And a significant portion of our non-public safety workforce is now enrolled in a hybrid pension plan, which comes at a much lower cost to the employer, to the town. The unfunded liabilities here are driven by the members of our legacy plans. But despite all this good work we've been doing for a decade or more, we have not been able to move the needle in a significant way to increase the funded ratio. And our annual ADEC payment, recall that acronym, that stands for the Actuarially Determined Employer Contribution, used to be called the ARC, now it's called the ADEC. It continues to go up each and every year at a rate that's much higher than the rate of inflation. So we've been working hard, but not making the progress we want to see here. Second, we all know that given the size of the unfunded liability in the pension plan, that's $315 million, the annual increases we're seeing in those ADEC payments, they're one of the main drivers in the growth of our operating budget. And we always focus on how can we better control those cost drivers in our operating budget. The issuance of the POBs, it would allow the town to fund our pension obligation at a lower annual cost than the method we're using now. And that will provide both tax relief moving forward as well as a fully funded pension plan. And as I talked about at the outset, our estimated net present value savings over a 30-year period are very significant at $140.9 million. Just a couple more points before I turn it over to Peter. The third reason why we're considering this again is that we have an opportunity, a very unique opportunity to take advantage of historically low interest rates. We've never seen this. That we could potentially pay 3% interest or less on these bonds, invest the proceeds in higher yielding classes, and that will enable us to earn, on average, over the next 25 years, 6.25%. So last but certainly not least, and I know we've spent a lot of time on this, Becky and her team, our actuary, they've completed testing of a very sophisticated model. They've looked at 10,000 different scenarios that demonstrates that the risk to the town of issuing the POBs, there is a risk, there's always risk, but that it's limited in that in less than 3% of 10,000 possible scenarios, in less than 3% would we exhaust that reserve fund. So that really shows that there's a 97% probability that we're going to have monies available in the reserve fund to offset any significant increases in the remaining ADEC period over that 25-year period. So what does that all mean? That really, all of those factors combined, they indicate that the town is very likely to realize some significant cost savings by issuing the pension obligation bonds, as opposed to continuing to finance our pension obligations through the ADEP payments that are increasing each and every year. So that is a quick overview I wanted to provide. I'll do something similar at next week's public hearing, and I would now like to turn to, through you, Mr. Chairman, to Mr. Privatera and other members of the team to talk first about the deterministic projections, and we can bring that, that handout up. And then secondly, to talk about how the reserve fund is structured.
Thank you, Mr. Hart. So, Mr. Privatera, you can go next, but when people speak, for the record, if you just identify yourself so that we'll know who said what, that would be quite helpful. Mr. Privatera.
Thank you, Mr. Chairman. Pete Privatera, Finance Director for the town. The town manager made some excellent points in his presentation. I think the two key factors here are a very low interest environment and the fact that, that we're asking to establish a reserve fund. We have never seen that before in this type of issue, and it's meant to insulate us from periods of economic downturn. I'm going to ask Urida to put that up, and then I'm going to ask Becky Seelman, our consulting actuary, to talk about how this was constructed. And what you'll see before you is basically what would happen if we did, on average, reach our 6.25% asset growth rate, what that would do to our pension liability over the next 25 to 30 years, but also what it would do to our reserve fund at that period of time. So I know it's kind of hard to read, and you're right, I don't know if you can blow that up anymore, but Becky, I'm going to ask you if you could just go through that and hit the highlights, and the rest of the team is here to answer any questions about investment strategy, market strategy, legal issues, how we're going to approach the bond market with this structure. So I'll turn it over to Becky Seelman, our consulting actuary, through you, Mr. Chairman.
Thank you, Mr. Privatera.
This is Becky Seelman from Milliman. Urida, maybe you could scroll down a few more lines so we're not seeing the heading on the page, but I would like to see the net present value figures. Perfect, right there. Okay. So this is a long-range forecast that it formed the basis for our analysis of the proposed pension obligation bond. This is one particular scenario that is designed just to illustrate the mechanics of how the pension plan funding works over time. It's based on an assumption that the plan's investments always earn 6.25% from starting next year. You can see in the column in green, the third column in, the investment returns each year are 6.25%. Now, of course, we know that will not happen, but this is instructive to look at because it illustrates how the pension obligation bond interacts with the other elements of the town's total cost for the pension plan. 6.25% is our current expert thinking on the expected long-term returns of the plan's investments when they are fully invested based on the plan's long-term asset allocation policy. In the short term, in the 18 months after the obligation bond proceeds are deposited into the pension trust, it is part of the plan to gradually shift those invested assets from very safe short-term investments into the full panoply of long-range investments. So you will see that for the first couple of years in this projection, the returns actually are somewhat shy of 6.25% because the obligation bond proceeds are not fully invested at that point. The next column is the accrued liability. That's the value of the benefits that have been earned by plan members in past years. You'll see that it grows over time as more active members earn benefits, although it does go down over time to the extent that retired members are collecting their benefits. But for this particular plan and its population and the benefits that this plan provides, we are projecting that for this time frame, the accrued liability will continue to increase over time. It's important to note that the accrued liability is not based on actual market performance, but it is based on an assumption about what future market performance will look like. So we've measured the accrued liability based on an assumption that the investments will earn 6.25% going forward. The actuarial value of assets, on the other hand, does reflect market performance. The actuarial value of assets is the name we give to an artificially constructed amount that is based on the market value of plan assets as of each June 30th, but with any market gains or losses gradually recognized over a period of time. That smoothing technique is important to protect the town's budget against volatility in the contribution amount generated by short-term volatility in the markets. Of course, with this particular projection, where we're assuming the investment returns are 6.25% each year, there are no investment gains or losses to create a bumpy road. But in actual fact, as time goes by, we will have up markets and down markets, and the asset smoothing mechanism is a very important way to protect the town. The unfunded accrued liability is simply the difference between the accrued liability and the actuarial value of assets, and the funded ratio is the ratio of the actuarial value of assets to the accrued liability. So there are two different ways of looking at the plan's funded status. And you can see that in 2021, with the issuance of a pension obligation bond, the plan would be essentially fully funded. There'd be a very, very small unfunded accrued liability that's attributable more to noise and imprecision in the system that is essentially a fully funded plan with the issuance of the pension obligation bonds. The actuarially determined contribution consists essentially of two pieces. The first is called the normal cost. That's the ongoing cost of benefits being earned by active members as they work for the town and earn another year of benefit service. There's a cost of providing those additional benefits they've accrued. It is offset by the contributions that the employees themselves make into the pension plan. The second and larger piece of the actuarially determined contribution is a payment to gradually pay off the unfunded accrued liability over a period of time. And you can see that as soon as the pension obligation bond proceeds are deposited into the pension trust on the third line down in 2021, that the actuarially determined contribution drops considerably because that second large piece of the contribution goes away. When the plan is essentially fully funded, the actuarially determined contribution consists only of those normal cost payments, and there is no additional contribution needed to fully fund the pension plan. As Matt and Pete alluded to, the plan is to take the contribution that you are budgeting for fiscal year 22 and deposit it into a reserve fund balance, a reserve fund, rather than contribute it to the pension trust, because you will be contributing hundreds of millions of dollars to the pension trust in that same time period. The reserve fund balance starts out at $26.919 million. That is the contribution that you otherwise would pay in fiscal 22 into the pension plan. And the reserve fund policy that has been drafted for you provides that beyond the first year of this transaction, if the actuarially determined contribution should go up by more than 5%, typically because of adverse market performance, that the operating budget would only pay that first 5% of increase, and the reserve fund would be drawn upon to pay the rest of the actuarially determined contribution. In the first year of the pension obligation bond and reserve fund, the policy before you provides for if the total town cost, that is the contribution plus debt service, should go up by more than 2.5%, the reserve fund would provide the rest. And that's an important short-term protection, because part of what's flowing into the actuarially determined contribution for next year and on is a reduction in the interest rate assumption used to calculate the actuarially determined contribution from 6.99% to 6.25%. A lower interest rate means a higher measurement of liability. In fact, if you look at the accrued liability column, you can see that it jumps considerably from 2020 to 2021 when that interest rate reduction is scheduled to occur. So you can also see in the reserve fund column that it is, we are projecting that it will be drawn on in fiscal 23 to the tune of approximately $823,000, and a very small number the year thereafter. And then under this simplistic projection scenario of 6.25% investment returns, we project that the reserve fund would in fact never be called upon again, that the plan would be very close to or above 100% funded for the entire period, and the actuarially determined contribution would not increase from one year to the next by more than 5%. This projection reflects the maximum pension obligation bond proceeds of $365 million that you're writing into the ordinance. The final amount borrowed may be somewhat less depending on the issuance expenses, but based on the maximum allowable bond amount, the annual debt service would be $20.961 million. That assumes that the bonds are issued at 3%, which we believe is a little higher than what we'll actually be able to get. So that debt service figure is conservatively high to the extent we know what today's market conditions are like. So the total town cost with the pension obligation bond would be equal to the actuarially determined contribution less any amounts being covered by the reserve fund plus the debt service. And then we have separately projected what the town's cost would be if there were no pension obligation bond, where the actuarially determined contribution would consist of the same normal cost with or without a pension obligation bond. But without a pension obligation bond, there would be a significant component of the town's contribution each year designed to gradually fully fund the pension plan over time. Down at the bottom of the page, you'll see that we've calculated the net present value of the town's total cost for this time period. We've used a 3% interest rate to calculate that net present value. That's consistent with what we've built into this model for the bond interest rate. And you can see for this scenario that the net present value of the town's costs with the pension obligation bond is, we project is $582.6 million, and without the pension obligation bond, it's $723.5 million. So on that basis, for this scenario, the net present value of the town's savings over the lifetime of the pension obligation bond would be $140.9 million. Now, of course, as I said before, we know that this particular scenario is not going to occur. If there's one thing we know, it's that we know this won't happen. But in order to evaluate the impact of the pension obligation bond on the town's future finances, we ran 10,000 scenarios just like this, only each scenario reflected a different 30-year forecast of investment returns, a mix of good years and bad years, all randomly generated, all reflecting the makeup of the town, the pension plan's portfolio. In some of those scenarios, particularly those with very poor investment returns in the early years, the town's cost with a pension obligation bond is in fact higher than the town's cost without the pension obligation bond. But as we looked at the number of such adverse scenarios, They were relatively small in number compared with the number of scenarios where the town's cost was lower with the pension obligation bond than without. And the median, that is the middle, the expected outcomes were quite favorable in terms of reducing the town's overall cost.
Becky, Mr. Chairman, Pete Privatera, Finance Director. I'm going to ask if Urida could go to the next slide so Becky could show what she meant by the median.
Yeah. Mr. Chairman, this is Becky Seelman. As I mentioned, we analyzed 10,000 scenarios. The graphs in front of you represent a sorting out of all of those scenarios into the best outcomes, the worst outcomes, and the outcomes in the middle. And we've characterized that the percentiles means what percentage of the scenarios are at that level or below. Let me focus first on the leftmost columns, which are measuring the net present value of the town cost, the figures we saw on the first page, for all of the 10,000 scenarios and sorting them out. The leftmost column shows the results with the pension obligation bond, and the right-hand set shows those same economic scenarios, but without a pension obligation bond. And you can see that the median, where half of the outcomes are better and half of the outcomes are worse, the median net present value with the pension obligation bond is 629 million, and without the pension obligation bond is 737 million. So on average, at the median, the town will save more than $100 million over this period, as expressed in today's dollars. However, it is important to note that the 95th percentile, the highest 5% of the scenarios, do result in a higher town cost with the pension obligation bond than without. And this is because the essential risk that the town bears with a pension obligation bond is you have millions of dollars more than you have right now that are invested in the market and subject to market risk. So there are some scenarios in which that market risk leads to a worse outcome, a higher cost to the town, than if the town stayed with the current situation with a 40% funded plan, much less in the way of assets, and therefore less dollars that are subject to market risk. Mr. Chairman, would you like me to also go through the other graphs on this page?
I think we have seen them before,
Mhm.
so I don't think that's really necessary. And I guess if any members have questions at this point, they could ask them. But thank you very much for the refresher on the previous slide. I think that's going to be quite helpful as we enter next Tuesday's meeting. So thank you. Mr. Hart?
Thank you, Mr. Chairman. Matt Hart, Town Manager. Maybe we could pause there for some quick questions on the slides we just showed, but then I think it'd be helpful to walk the committee members and other council members through the reserve fund ordinance, how that's been structured.
Okay. So upon Mr. Hart's suggestion, does any member have any questions with respect to what's already been presented so far this evening?
Mr. Chair, this is Mary Fay. I have a couple quick questions, and you're right, we've seen a lot of this information before. It's always good to go through it in more detail. So I'm kind of coming to the punchline that show that there's savings for doing this, mostly in the outer years, not so much in the beginning years. But I worry about the other percentiles. So can you refresh my memory and let me know what the asset allocation of the investment is to be able to, track to the 6.25 discount rate?
Thank you, Councilor Fay. I think that's a question that would be somebody who would be a staff member to our pension board. And so, Mr. Privatera, maybe you can let us know that answer. Thank you.
Thank you, Mr. Chairman. Pete Privatera, Finance Director. The current asset allocation, and I'd like to turn it over to Chris Cashmere after I finish, our investment advisor, is 65% equities, 35% fixed income, and 5% real estate. The plan we have, and I'd just like Chris to comment on it, involves a gradual investment of those funds over the first 6 quarters, so we don't get into a situation where we take the entire $359 million and go out and dump it into 65% of equities, and then have something happen in the economy and we find ourselves at a loss. So I've been working with Chris on 2 issues. One is an allocation strategy that Chris is going to present to the pension board on Monday. And 2, I asked Chris to do a little research as to how our investment strategy has worked over the last 5, 10 years, 20 years, and what our asset growth has been. So, Mr. Chairman, if you don't mind, I'd like to have Chris Cashmere, our investment advisor, comment on that.
Great. Thank you, Peter. Through you, Mr. Chairman. Chris Cashmore from DeMaio Schneider Associates. So Peter alluded to the existing asset allocation strategy, which is, as mentioned, for the sake of conversation, I suppose, about 2/3 what we call risk assets or equities, and then the balance in predominantly fixed income securities, and then a small diversifying allocation, about 5% of the portfolio in conservative core real estate investments. That portfolio over the last 20 years, ending in December, interestingly enough, is annualized from a return perspective at 6.6%. As a frame of reference for the council versus the 6.25% that Becky and others have referenced. So there is a practical history, if you will, of an ability to achieve that return. And I would just offer up as an additional a lens, if you will, or optic, the allocation strategy has not changed all that much through time. So it has been anchored largely where it is today, and I think is reflective of kind of the earnings potential for the program going forward. To get there ultimately with the proceeds, as Peter mentioned, we've devised a dollar cost averaging strategy, which will accept the proceeds of the issuance into the portfolio on day one, early in the new fiscal year, but will not obviously be invested in that ultimate allocation until a period of 6 quarters has been completed. And as Peter further referenced, the motivation for that is to avoid pitfalls or market volatility or things that can happen out of our control that makes us susceptible to really bad starts, if you will, out of the gate, right? So the intention is to take those proceeds and then in 1/6 increments over the course of 18 months, bleed them in, if you will, to the larger portfolio into that ultimate strategic allocation strategy that we just mentioned. We're currently working with the pension board and Peter, kind of thinking through the dynamics and particulars of that dollar cost averaging pool and what it will look like. I can assure you that it'll be devised predominantly of high grade, liquid, shorter duration, very plain vanilla fixed income securities, with the recognition, as Becky and Peter and others have mentioned, that comes with a little bit of a return hurdle or headwind, if you will, on the front end, right? Because clearly those type of instruments don't earn with the full power of the larger portfolio that leans into equities and other risk assets. So we think that is a thoughtful, measured way to get that magnitude of monies into the program. And it has been fully reflected, I think, in some of the numbers you've seen before you this evening.
May I ask, what's the beta on the investment portfolio?
Could I ask Council Member Fay, beta to what particular, to the S&P 500, to
Yeah.
bond?
S&P, yeah, please.
Yeah, I would have to say, if I could, I would ask if I could get that number for you. I don't have it readily at hand, but I can certainly get it and share it if that's okay with the council.
Then fine. I'm just trying to assess how much risk we're taking on to try to do that 6.25. I don't want to steal everybody's time. If somebody else has questions, I can certainly. I just wanted to mention that Matt had arranged a meeting with myself and Lee, and I think too, to get more details. I can certainly do this offline. I don't want to run up with things.
This is Councilman David O speaking. I think tonight's the opportunity to ask our questions so that we all can hear them. We're running short on time before we're going to be taking this to a vote. So I would appreciate that if people did have questions this evening, that they do raise them as sort of our last final. So Councilor Fay, if you do have further questions, please ask them.
Certainly. I just have more, if I may. Thank you. So let's see. With the interest rates, I'm getting a little nervous, and I know Janet Yellen will be our new Treasury Secretary, and I've heard in the mortgage rate market, rates are increasing. What's like kind of a nominal interest rate, either in T-bonds or something, where this wouldn't look as favorable as your projections here? So we said we could probably borrow at 3% or less. If rates continue to rise, I know this takes a while to do the transaction. What would make it look unappealing? What kind of rate environment?
Mr. Chairman, it's Pete Privatera. I'm going to let Becky answer that because I asked Becky to run a couple different scenarios with lower interest rates to see what would happen. And obviously, if we were to achieve a lower interest rate, our unfunded liability would just increase tremendously. But we did run a few scenarios, and even at 6, at 5 3/4, and I believe at 5.5, I believe it was still viable. There was still a positive outcome. But if we ever ran this at 3%, obviously a 3% growth rate over a 25-year period would be pretty much devastating for the economy. But I'm going to turn it over to Becky and ask her through you, Mr. Chairman.
Thank you, Mr. Privatera. Ms. Seelman?
This is Becky Seelman from Milliman. I believe Councillor Fay's question related to the rate at which the bonds could be issued. We did all of our modeling at 3%. In a sense, so long as you can issue bonds at anything less than 6.25%, the median outcome for the town will be favorable. But as the gap between the bond rate and the long-term investment returns on the plan's assets narrows, the savings will also narrow, and the investment in risk will take on larger importance relative to the savings. We did look at what if the bonds were issued at 3.5% or 4%, and I think there's still a credible case could be made for that being a favorable condition for issuing pension obligation bonds. I also have for it, this may help Councillor Fay with your first question with respect to the investments. The standard deviation of the portfolio returns, that is the riskiness of the portfolio based on Milliman's capital market assumptions, is about 10.9%. And that may be a helpful metric for you.
You, Becky, that is very, very helpful. Thank you for that.
Anything further, Councillor Fay?
Yeah, hold on 1 second. Oh, Becky, I know that the discount rate, very helpful, thank you. The discount rate is one of the bigger drivers for change liability, but also by the table was updated to,
Mary, we can't hear you. You're fading in and out.
can you hear me now?
We can. Can you just restate your question?
Yeah, I apologize. I don't know why the acoustics are bad where I am. Yes, please. Could you tell me, like, biggest driver I know is the discount rate and moving liability up and down. That's one of the
Mary,
bigger ones.
we're losing you still.
Hold on. That's strange because I'm sitting in the same spot. How about now? Hear me
Still
now?
fuzzy.
Very difficult.
All right. So you can hear me.
This is Becky Seelman. I thought I got enough of your question that you're asking what other key assumptions drive the liability. Is that correct?
Councillor
Yeah.
Fay, is there a way that you can call in or type your question into the chat box?
Sure. Let me just one more time. Can you hear me now?
Yes, we can. Go ahead.
I apologize. It's crazy. It's my internet connection. Yeah, Becky, you're absolutely spot on. What are some of the other assumptions or drivers could move the liability up and down?
Mr. Chairman, with your permission?
Yes, Ms. Seelman.
Okay, this is Becky Seelman from Milliman. There are several important assumptions that drive the calculation of the liability. We have recently updated the mortality assumption with respect to how long members are expected to live and collect pension benefits. So that assumption currently reflects kind of the most recent available information about how long public pension plan members are living today, as well as an assumption about how much longevity will improve in the future. Excuse me. We also make assumptions about rates of turnover. How likely is it that a town employee today will stay working for the town long enough to qualify for benefits? We make an assumption about retirement patterns. Not all members retire when they're first eligible to do so. And so we have an assumption that members will retire gradually over a period of time. We also make an assumption about the rate at which pay will go up between now and when someone retires, because the benefits are based on pay at retirement. Those are the chief assumptions that go into the measurement of the liability.
Thank you very much, and I am all set for now. Thank you very much, everybody.
Thank you, Councillor Fay. Any other member of the council?
Mr. Chairman, before we move on, if you wouldn't mind, we've had some talk about the bond rate. If you don't mind, I'd like Bill Lindsay just to comment on that, because we've had some significant discussions on what our expectations are And throughout this whole process, we've been very conservative on the bond rates, on the asset growth rate. So if you wouldn't mind, I'd just like him to comment on that. Thank you.
Absolutely, Mr. Privatera. Mr. Lindsay.
Thank you, Mr. Chairman. Yeah, we did, as Becky mentioned, run some interest rate sensitivities at higher rates. And I would, what she said is that it was absolutely correct. Is the target rate here with the 6.25 discount rate or internal rate of return for the plan, that would be the break-even rate on the borrowing cost. We're quite a ways below that currently. We've been using a 3% borrowing cost, and we're probably comfortably 50 basis points below that in the current market. And we have seen some increases in the near term in say the 10-year Treasury rate. It's gone up from when it was in the 0.9%, and it's up to somewhere just shy of 1.1% currently. And so any increase in here will obviously have a negative effect on the overall savings that the town realizes. But the borrowing the time frame for us to come to market here is relatively short. We're measured in months, and as as Mr. Ritter could explain in more detail, it is a statutorily derived process where we do have to follow the statute in terms of review periods and comment periods with the state of Connecticut. But we should be measuring this in months. So we're talking 60, 90 days, 90, say 90 days, 100 days, to really kind of get this to market. And I think that, with that in mind, I feel that, we still have a very favorable interest rate.
Thank you for the answer. Much appreciated. At this time, is there any further counselor questions with respect to the pension obligation bonds? Seeing none, Mr. Manager, do you have anything further you'd like to add at this point?
Thank you, Mr. Chairman. Matt Hart, Town Manager. I just think a brief explanation of the reserve fund ordinance and how that would work would be helpful. And I would turn to Mr. Privatera and potentially Attorney Ritter to do that. Through you, Mr. Chairman.
Thank you, Mr. Hart. Mr. Privatera.
Thank you, Mr. Chairman. The ordinance was structured so the reserve funds can only be used to offset the pension liability or the debt service on the pension obligation bonds. And as Becky Seelman had mentioned earlier, there are a couple triggers in that. The first trigger is the year after we sell the bonds. We wanted the trigger to be 2.5%, meaning the town would pay the first 2.5% of any increase, and anything over that would be paid by the reserve fund, because we knew there would be a negative impact from dropping the discount rate from 6.99 to 6.25. So we took care of that issue. The second issue was we wanted to limit the town's contribution to 5% on a year-over-year basis. And that's a second item. Now, what's interesting is if you look at our current actuarially determined employer contribution, it's roughly $27 million next year. So if we went up 5%, we'd have to cover an increase of $1.35 million. After we sell the bonds, our ADEC or our annual contribution is going to drop down to $7 million. So there's a big difference between the liability between where we are today and where we're going to be after we sell the bonds. And the third piece that we wanted to put in place was that there could be no arbitrary decision made on using these funds to pay down debt unless an actuarial analysis was done to show that the pension fund would still be viable after we paid down a certain amount of debt. And that's a trigger we put in place too. And, through you, Mr. Chairman, I don't know if Matt Ritter or Corporation Counsel Dallas Dodge want to comment on this, because we were all instrumental on putting this together. Thank you.
Thank you, Mr. Privatera. Does either Mr. Ritter or Mr. Dodge wish to comment?
Thank you, Mr. Chairman, Dallas Dodge Corporation Counsel. No, I think that the finance director explained the POB reserve ordinance very well. Procedurally, the way that this would work, obviously, these are both going to be on the agenda on the same night, and so the council would first adopt the pension bond obligation, the ordinance authorizing the issuance of the pension bond obligation bonds, and would then also, on the same evening, adopt the ordinance establishing the pension bond reserve fund. And I am happy to answer any questions that any councilors may have about the operation of the reserve fund ordinance.
At this point, do any councilors have any questions about how the reserve fund would operate? Seeing none, Mr. Dodge, I think we're all set. Anything further from anyone else, Mr. Hart or Mr. Privatera?
No, thank you, Mr. Chairman. I think we've hit all the high points of this presentation. Thank you.
Thank you. Thank you. So I'd like to thank everybody for joining us this evening. I personally found it to be a good refresher since it had been a while since we had discussed all these items, and hopefully we'll keep it fresh in our mind for Tuesday evening, which is just around the corner. This is a very significant issue that has very significant impacts upon budgets in the very near and long term for our town. And this is probably going to be one of the most significant votes that we will have cast as a council in probably decades. So thank everyone for their attention and attendance for this presentation. Thank you very much. With that said, we can move on to why don't we go to item number 4, which was the meeting minutes. I will presume that everyone has read them, and if there's no objection, we'll just accept them as presented. Is there any objection? Seeing none, we'll just have them be received as presented. Next item would be staff reports, and that would be Mr. Hart.
Thank you, Mr. Chairman. Matt Hart, Town Manager. Very briefly, we'll have a number of items, finance-related items, various smaller appropriations, etc., on your regular meeting agenda for next week. So I thought it would be useful for Mr. Privatera, when you get to him next, if he could just briefly, very briefly describe each of those so that you're familiar with them when you see them on your agenda for next week. And then secondly, Mr. Privatera also has an improved report to share regarding where we stand with current year projections for fiscal year 21. We've had some positive recent developments that have improved our projection. We still need to, and we will continue to manage the budget very, very carefully at a staff level. But again, some better news to share. So that's all I have, Mr. Chairman, and would cede the bulk of my time to Mr. Privatera.
Thank you, Mr. Hart. Mr. Privatera, if you want to first outline the various resolutions which will be on the council agenda that have a financial impact on the budget, and then give a brief overview of your finance report dated January 20th.
Thank you, Mr. Chairman. Pete Privatera, Finance Director. We have one resolution for $60,000 awarded related to a distracted driving grant. Another resolution for $12,333 related to a FEMA emergency management grant assistance to firefighters. We have a resolution to appropriate $1,009,407 from the Connecticut Municipal Coronavirus Relief Fund. We have a supplemental appropriation to appropriate $84,488 from additional funding we receive related to grants for the election. We have a resolution, a minor resolution, but we do have to, but it needs to be passed. The CDBG resolution amending the CDBG budget by $160. We have another resolution for $74,652 related to a comprehensive DUI enforcement grant. And then finally, we have a resolution accepting a donation of $3,000 from the West Hartford Women's Soccer Club to be used for soccer field renovations. And that's the extent of the resolutions, Mr. Chairman.
Thank you, Mr. Peter. I did get a text from Corporation Counsel on the minutes. I need to have a motion for the minutes to approve them. Mr. Sweeney. Thank you. Is there a second? Ms. Fay?
Okay.
Thank you. Moved and seconded. All in favor?
Aye.
Okay. The motion carries. No objections. Mr. Privatera, just a question on those various financial matters that you mentioned. Is it our intention, if there's no objection, just to place them on the consent calendar?
I would suggest you do that. I don't think there'll be any objection to any of these grants coming in.
So with that said, and the understanding from the finance director, does any member of the council have any further questions about any of those resolutions? Seeing none, then I think we'd be in a good position just to place all those on the consent calendar next Tuesday. Thank you. Mr. Privatera, do you briefly want to give an overview on the 2021 budget?
Yes, thank you, Mr. Chairman. Pete Privatera, Finance Director. As of the end of December, we're projecting a slight surplus of $105,282. If you recall, our last projection was significantly lower. We were projecting, I believe, a $1.6 million deficit. In the interim, we were notified that we will be receiving a reimbursement related to the Storm Isaias costs of up to 75%. We're expecting $468,000. There was finally a FEMA declaration on that. As part of our deficit mitigation plan, the town manager asked departments to come up with a series of givebacks that we could set aside. Departments came up with approximately $375,000 of givebacks that we're going to be holding. Our tax collection rate so far has been very good. We're projecting we're going to exceed our 99.1% collection rate. Our projection right now is an extra $650,000. I'm hoping that at the end of the month, when we have most of our taxes in, we'll be able to take a very close look at that. We only had a handful of deferments related to the governor's deferment program, but all indications are that that we'll be in a good position. And the termination pay for retirees that we had set aside, it appears that we're not seeing the same level of people put in their papers. I think most of the folks put their papers in at the beginning of the fiscal year, maybe for tax purposes, maybe for some other purposes. But we've only seen one additional request for retirement, and our expectation is that we're going to be a little less than what we previously projected. So all in all, based on that, and based on the application of using the fund balance that was part of the adopted budget, we're projecting a slight net surplus, and we'll continue to monitor this throughout the course of the fiscal year. Thank you.
Thank you, Mr. Privatera. I do believe that the report is loaded on board docs. Does any member of the council at this point have any questions with respect to the latest projections from Mr. Privatera? Thank you very much, Mr. Privatera. Seeing no questions from any members of the council. Mr. Hart had one additional item under staff reports. Mr. Hart.
Thank you, Mr. Chairman. Matt Hart, Town Manager. Just want to take the opportunity to mention to the council that you're likely going to see a suspense item on Tuesday night as well. A suspense item, that is something we need to introduce, and we can only do it at a regular meeting. something that comes in after the official agenda has been posted. So we did get word from Plant and Facilities today that we need to take some action on our applications for school construction grants. And interestingly, I think these are 4 projects that you already approved. They're part of our capital plan. But I think when we originally submitted them to the council, we did so in one combined resolution. And turns out the state is saying we need 4 separate resolutions for each of the projects. So those are for a partial roof replacement at Hall High School, partial roof replacement at Sedgwick Middle School, flooring replacement at Norfeld Elementary, and flooring replacement at Webster Hill. And school construction grants, they will offset the cost of the project, and the town share of these projects we have already budgeted in our capital plan. So it's not really going to have a financial impact, but we are going to be looking for you to adopt these resolutions. And unfortunately, we need to, given the timing, introduce them as a suspense item. I would ask Attorney Verano if there was anything she wanted to add to my quick explanation.
No, nothing further, Matt. I think you gave a good description of the issue.
Thank you, Attorney Verano. Thank you, Mr. Hart. So that concludes all the general items on the agenda. So if we go back now to item 2A, it's an executive session item. So without objection, I move that we enter an executive session to discuss the settlement of a tax appeal filed by SFWH Property Owner LLC, the owner of property located at 1445 New Britain Avenue. Is there any objection? There being no objection, the motion passes. We can enter the executive session via new WebEx login. So I guess we leave this meeting and then go back to that executive session.
Mr. Chair, if I just may make one comment.
Sure.
Deputy Corporation Counsel Gina Verano, I just want to acknowledge that we will likely be coming out of executive session and taking action at the public session. Thank you.
Okay, thank you.
Mr. Chair, before we proceed, I'd just like to ask Jerida and Jen to make sure that we are back on TV before we proceed. Thank you.
Thank you, Ms. Verano. Mr. Gold texts me that he's not coming back on. So I think we just need to find out Mayor Cantor and Mr. Williams if they're coming back on.
And do we need them to vote though?
No, but Mayor Cantor's here. So, we're good. And so just waiting to find out if we can proceed with Ms. Evans. And you're right. Can you tell us when we're able to move forward?
I apologize, Deputy Mayor Davidoff. WHCI is all set.
Okay, thank you.
You're welcome.
Okay. Before we go any further, I do need to point out on advice from Corp Counsel that Mr. Dakers was present during our executive session and was invited to join us. So let the record please reflect that. So without objection, I move to ratify the settlement of the tax appeal filed by the owner of property located at 1445 New Britain Avenue as follows. The fair market value of the property on the 2017 grand list shall remain unchanged through April 28, 2018 at $10,739,900. The fair market value of the property on the 2017 grand list after April 28, 2018 is $25,500,000. $500,000, I'm sorry. Not 500. Let me just say that again. The fair market value of the property on the 2017 grand list after April 28, 2018 is $25,500,000. The fair market value of the property on the 2018, 2019, and 2020 grand list is $38 million. Is there any objection? And please note that the only people who can object or vote would be members of the committee. And that would be myself, Mr. Sweeney, and Ms. Fay. So is there any objection, Mr. Sweeney? Mr. Sweeney says no. Ms. Fay, any objection?
No objection.
I have no objection. There being no objection, the motion passes. So therefore, without objection, I move to adjourn the meeting. There being no objection, the motion passes. The meeting is adjourned. Thank you.